Morning, guys. Thank you for tuning in. This is Hannah. I'm a CPA based of Los Angeles. And as you can tell, the topic for today is one of my favorite ones to discuss, 401k. If you saw my older video, we did go over some of the benefits or some of the concerns for H-1B visas. And one of the things that came up was a 401k. As promised, I did say we will be making another video on a much more detailed outlook of the 401k, go in a lot more details for understanding what it is, just because I think it by itself is just a huge topic to begin with. Basically, what I'm hopefully by the end of this video, what you will understand is what a 401k is, how it works, and some of the best questions I could get is, what happens to it if I get fired? What happens to it if I just leave? Can I have two different 401k accounts? Can I withdraw it? How much is the penalty? How does the taxes work? Is it only for long-term perspective? And everything in the middle. And I will try to get to all of that in a very simple way. So let's begin. I will reiterate, though I'm pretty sure a lot of people are already aware of this. A 401k basically is an employer-sponsored retirement planning for anybody who wants to take advantage of it. It is a tax-saving vehicle. It certainly lets you put pre-tax dollars towards your retirement goal. And one of the best part of that is usually, I would like to say, I don't want to say 100%, but let's say usually a lot of employers do match a certain percentage of the employee's contribution into the plan. And that is like that cherry on the top, literally a money given to you free and not to be not to let go for. So certainly that is one of the driving factors why I think everybody should invest in 401k, at least as much as by that percentage. So again, a 401k is a retirement vehicle. So as like with any retirement accounts, you cannot withdraw money, at least without penalty, until the age of 59 and a half. And if you are one of those fortunate who can or are working way past that age and don't decide to use the 401k, when you do hit 72, you will have to take mandatory withdrawals at that age. So between 59 and a half, you can, and 72, it's up to you. You do want to take it out, feel free to do it. There is no penalty. You definitely qualify for it. But if you don't want to, it's all good. Let it grow. But as soon as you hit 72, there is a minimum withdrawal that you will have to start taking. And basically enjoy the benefits of all that saving you've done over the years. So certainly that's one way to look at it. I'm just going to go over some of the questions, like I said, I saw, and I will hit those. How it works. We are looking at, like I said, it's a pre-tax dollars. Your money goes into a brokerage or whatever accounts your employer provides. You get to choose how you want to invest it. Most of the time, the employer does give you enough options. Now, this could range between mutual funds or, certain indexes, or just put it and play by yourself into stocks, if you are up for that yourself. So it just depends upon what your employer at the end of the day provides you with. But there are more than enough options, which I think should make things easy. With that being said, I do have to say that a lot of employers also provide you a standard package from the 401k, which is basically how you want this money to be invested: risky, moderate, or like conservative. So if you don't want to have the hassle of going with individual funds and how they work, or having to decide yourself or actually play the stock market, you could literally just dump the money in one of these funds based on their classification and let it go. They will put the money per the nature of the fund. If it is conservative, of course, you relatively do get less rate of return, but your money is more secure. Something I do suggest for those who are closer to retirement, you don't want to mess with that money and be, way too experimenty with it. And then there is people who definitely don't mind playing the risky field. For them, then there's definitely the accounts that they put in a more risky stocks or investments. Of course, the rate of return can be all over the place, but you do have to accept the risk that comes with it. What goes up must come down, and usually that's something that's probably not everybody's cup of tea. And then there's that happy medium in the middle, which will be a balancing act. The rate of return generally is around whatever your S&P index maybe, or your stocks averages maybe, which is, I mean, is pretty good. The risk to your money is a happy medium. You're not kind of waking up on a roller coaster ride, but you are not being that turtle and barely making, compared to if you see people around you really minting this. So usually those are your options available. Now, some questions. Can I have two different bank 401ks? You most certainly can. And usually that happens when people switch jobs. You have an older employer who had a 401k, you invested with them, and now you have a new employer and they have a 401k, you start investing with them. The only difference is, how much do you want to diversify in terms of, do you want to have two different accounts, or you rather just put it all together into one? There is no, it's all literally up to you. Technically, there's no one stopping you. You could have 3 different accounts for all I care, or, there is none. Like, every employer could have a 401k account. You could have one with each employer and let it be set like that. If you don't want to do that, you'd rather have one. The moment your 401k at the new employer is up and running, it's as simple as a phone call making to your funds, or your whoever is managing the 401k, to have them transfer it to, or basically roll over to this new 401k, and that just does it for you. You'll all have it all in one place. So that's that. There is no problem in terms of what your balance may be if you do switch your jobs. Some companies or employers may have a vesting period for the portion that they are putting into 401k. But assuming all that is in clear, whatever the balance is, it kind of rolls over as it is. That being said, now if you are fired, there are some employers, especially some smaller ones, who may have a clause that if you're fired for basically whatever, the employer portion of the 401k contribution may not be given to you or considered vested, or basically they have the right to withdraw it back from you. Now keep in mind, nobody can take away your own contribution. That is 100% yours, however the market behaves, but that is yours. It's just the employer portion that does that can or does change depending on whatever their policy may be. So that's basically, hopefully answers your question. Now, penalty. Yes, there is a penalty if you were to take out this money before the stated age of 59 and a half. Unless you do have some exemptions. There is, if you do have financial hardship, there are medical bills you have to pay, and of course that will lead to financial hardship. Or you could use or loan the money out of the 401k if you want to buy a house. But that's more like a loan. But in order to cash it out, it's basically financial hardship is one of the biggest one, where you can take it out and there won't be any penalty. Hopefully none of us have to be in that situation, but those are one of those few things that at least the penalty doesn't apply. And like I said, you can loan the money to yourself if you do need the money for whatever reason, and then pay back into your own account. So that's one of the ways that the 401k also helps, kind of like a piggy bank of the savings on the side. It does have a clause though. If you were working for the same employer and take out a loan, that is definitely fine. But if you were taking out a loan of a 401k from an employer that you're not working with, now that cannot be treated as a loan, because there is no guarantee you'll be able to put the money back into your account before you leave the employer, because you're no longer with the employer. I hope that makes sense. I'm going to reiterate it again. You can take a loan out of your 401k as long as that 401k is with the employer that you are taking a loan out of. because there's a guarantee. You work for them. Every time you are paid, they can deduct the payment of whatever your monthly payment of that loan would be back into 401k. Now, if you have one of the older 401ks, or you now don't have a 401k with an employee because you work for yourself, or you don't have a job and you take out, now you can't do a loan because there is no guarantee and there's no one else to, like, who's going to come to you and say, put the money back in. So in that case, it is considered a payout. So keep in mind, even though loan is available, it is only available with the employer you actually work with. That should settle that. Is a 401k a bad idea if long-term is not my input? If contributing long-term is not my goal. 401k, in my view, is never a bad idea. And the only reason for that is, keep in mind, we all can always save, and we should, especially considering, I don't know how many else are waiting for on Social Security to be our savior, but that is just not happening. It's a depleted resource. Even if, let's say, if somehow by miracle it's available by the time you and I decide to retire, it'll be anything but peanuts. Maybe pays for a few of my coffees at Starbucks, but that's about it. So retirement planning is certainly something that's up to you. Ideally, I would love, and I do tell all my clients to maximize it, just because from a saving standpoint, from a retirement planning standpoint, but foremost, tax situation. You do get a credit. You don't have to pay tax on that money. So yes, why not? Because in every calculation, if you were to do it, if you don't put the money in 401k, that's extra money that you will have on your W-2 that you'll anyways pay taxes on. So why do that and not put a little bit at least to your savings account and build this a decent pot for you when you are a little older, or, let's just call it a little older, around 65, 70, and have this pot available to you, because, a little just does add up. And I will go over some numbers, like the magic of. We will discuss now what I call the magic of compounding. And the reason I love this is one of my favorite parts of this discussion of the 401k idea, is because it tells just the reaction that people get. I get from people who are listening to those numbers, because in all honesty, we do forget how this basic calculation works, which we all are aware of, but somehow forget it in our calculation while doing the 401k. Now, let's assume we're going to take some very, very realistic numbers and make a calculation based on that. I will be looking at my cheat sheets because I do not want to mess up when it comes to numbers and their calculations. So what we're assuming here is someone with a $60,000 salary annual who will be doing a 6% match for 401k, and the employer is willing to do 3% match of the 6% from the employee. So in order to maximize the benefit for the employee, they should put to 401k or towards 401k at least 6% of their salary, at which the employer will do the 100% match that they can on a maximized calculation. So at a 60,000 salary, we're looking at a 6% employee number to come down to $3,600 for the year. With an employer match of 50% of that at 3% comes down to $1,800. So at the end of the day, for the entire year, we're looking at your 401k adding about $5,400 in your account. Now, forget everything else. In terms of, of course, there's a nitty-gritty of every year that you are putting, the market is changing and all of that. We're going to keep it, let's say, at cash value. For the 4 years, you put this amount in your account for 4 years. Maybe you're working for 4 years, decide to work for yourself. Maybe you were here in this country, and as I suggested, you did listen, at least took advantage of the employer match and put this little bit towards your 401k, helped your tax bill at the end of the day as well. And now you work for a few years. For a mathematical calculation, we're going to do 4 years. And it was a cash value, okay? So we're not gonna factor in the market as of right now. So $5,400 every year, if you were to put, after 4 years, the cash balance in your 401k account is going to be $21,600. Now, you decide not to put a penny more than that into your account and let it be. But now this money actually is sitting in the market. Earlier it was in cash for our calculation purposes, but now at the end of the day, all 5,400 times 4 ends up being 21,600. You decide not to put any more money into the 401k account, but do invest it into the funds. And for our calculation, we're going to assume a very realistic rate of return of about 7%. Considering today's day and age, that is, I mean, I'm sure it's conservative, but then again, we're going to have some days where other years that market may crash and you'll have less. So we're going to average out a 7%. And I think that's quite reasonable considering how between historic data and how we are today, where that percentage stands. So going back to the original number, 21,600, that is your amount collected after 4 years of the employer and employee match at $5,400 per year. Ends up at 21,600. We put it in the market for, let's say this was done at the age of 30. You started putting at the age of 30. It's 34 years. You stop it. You let this money sit at the rate of return of 7%, and we do not touch this money for 35 years. Which is fine because if you were to stop at 34, you let this money sit for 35 years, you're looking at 69 years. That's a decent amount, decent age where I think if you can, you should kind of enjoy life a little and not be working. But let's say, we're looking at 35 years. At 7%, without putting a single penny into that 401k, when you hit the 35-year mark, this balance in this 401k is looking at $230,614. That's not something I just made up out of thin air. You are free to go make some calculations. Go Google retirement calculators, put some numbers in. You will see, and that's what I mean, the magic of compounding that we all tend to ignore and how this adds up. Now, let's say you were to let it sit there for 40 years, and that time we are looking at about 64 years of your 74 at which you will, let's say, fully retire, or you started at the age of 26 putting it into your 401k. You put it for 4 years, 30 years, you let it sit. You basically stop investing at the age of 30. You let it sit there for 40 years. Now we're looking at 70. If you do that, with the same number, 21,600, rate of return of 7%, sitting for 40 years, your balance would be $323,000 and $448. That, my friend, is what I'm talking about. It may not look like big amount when you started, and unless you really need money, we all have those times during our lives where we really need to cash out, is a different story. But if you can hang on and let this money sit, it will give you benefits like none other. So let it be. All of a sudden, it is not the peanuts. If you are one of those people who decide to leave the country, I would like to give you the argument that US is one of the safest places to put your money and let it grow. Maybe you send your kids back here to study. You can use that money for your student expenses. You could use this money to pay off, anything that you wish in that category, or just enjoy it at that point. That being said, I am sure there are a lot of people who just have to take the money out because they need it for whatever reason, and that's acceptable as well. Just keep in mind that since you did not pay taxes to begin with, when you put this money into your 401k plan, it will be taxable when you do take it out. Also, there will be a 10% penalty that will be attached on top because you took it out before the 59 and a half age. Now, if you were to do it after that, it's just the taxable amount and no penalty involved. A little detail for all those that are on H-1B visas. There are ways to be able to take this money out in smaller chunks and be able to not hit with the tax portion of it, but certainly the penalty you cannot get away with. But at least, let's say you are on H-1B and you decide to go back to your country, and there is, you will use the same number for the argument, the $21,600 sitting in the 401k, and you do decide to cash it out. If you are married and you were filing joint taxes in the US, I hope you do realize you do get, as of right now, a standard deduction of $24,000. Now, this amount is under the standard deduction of the $24,000. So ideally, when it comes to what amount will be taxed out of this amount for your 401k is zero, because it is less than that amount. It would be best to do this the year after you leave the country, because the year you are in this country, you still have a W-2. You rather not add an extra, even though $20,000 to your already, the W-2 that you have, and then raise your taxes. Let it sit there for the year. File or take this distribution the year after, when on US soil, or at least in the US earned income is zero, because you were not working here, you were not staying here, you didn't make any money here. So all the income that you're going to have on your taxes is going to be what you take off of your 401k. Now, like in our example, the balance is $21,600, which is way less than the $24,000 standard deduction that you get for married filing joint. So when it comes to at least what amount would be taxable, it actually would be none, because you are below the threshold. That being said, there would be a 10% penalty. So we are looking at $2,160 as penalty that you'll have to pay, which, if you ask me, considering that your employer was already putting in $1,800 every year for 4 years into your account, it's a little over 1 year of that amount that you used, in a sense, to pay for taking out an early distribution. So that's one of the ways where you could be able to do that. Now, if you do have a bigger balance, you could use the same strategy. It'll take you longer to get all the money back to your home country, but at least you can get away with not having to pay taxes. It's just the penalty portion that you can take care of. And meanwhile, while the money is sitting here, it'll grow a little and kind of pay for itself. With that, I think I did cover everything I wanted to in this for this topic. I hope it made sense, got you some points across that you were probably looking for the answers for. Again, if you have any questions, feel free to comment in the section below, and I will reply to those. This definitely is, there's a lot more to this topic, and the interesting thing is it does apply to everyone in a different way. So very understandable if you do have questions after watching this video. With that, I will wrap it up. Anybody who has been following me knows I like to end my videos on a positive quote. I found one which I think is perfect for the topic we were talking today. So I kind of picked it up. Don't have an author on that, but the quote goes like this: "Small steps in the right direction can turn out to be the biggest steps of your life." With that, you guys take care, and I'll see you in the next video.